This is Stephen's Story once again with tips on trading. I have used many different brokers in the market, retail brokers or the market makers, also ECNs, which don't have a trading desk in the end. There are several things a person needs to understand about some of the methods that brokers may use to protect their own interest, especially the retail market maker. I'd like to talk and hone in specifically on the spread rate. There's two different types of spreads basically. One is a fixed spread rate, which you'll probably not see as often, but it exists, it's out there with some brokers. And then you have a variable spread rate, which is quite common. Variable spread rates are common because that's pretty much the way the market works. The spreads will vary according to the volatility of the market, according to the reactions in the market. Spreads will increase with higher movement of price, and they'll decrease with lower movement. That's for the typical trader working with, the small trader working with a basic retail or market making broker. Let's focus on the variable spread rate for a moment. The reason variable spread rates are dangerous with some brokers is because the broker who has a dealing desk or the liquidity provider that backs that broker is often using a variable spread rate as a stop sweeping tool or a stop hunting tool. Your stops are supposed to be there to help protect you as a trader in case your trade goes the wrong way and it stops you out automatically rather than allowing you to lose more and more money. However, with a variable spread rate and a liquidity provider or a broker who can manipulate that spread rate much more so than is usual, they can take an existing trade that's already entered into the market, increase their requirement for the spread rate, and if your stop is set within any range in which that spread rate will increase, it can stop your trade out, winning for that market maker your losses, also the spread rates, and taking it away from your account. So setting stops becomes a little bit of a challenge when you're working with a broker who uses a variable spread rate, especially those brokers out there I can think of 3 or 4 right now, right off the top of my head, that I would not recommend, and I'm not going to mention their names right now, but you need to do your research for a broker. Make sure you're finding one that is not going to use excessively variable spread rates as stop hunting tools or stop sweeping tools, which make your stops essentially ineffective. You need to find brokers, if they are using a variable spread rate, that are more reasonable. Do your research, check them out, use their demo accounts to find out how they react in faster moving markets and how they interpret a faster moving market, which determines when they decide to increase the spread rate. The spread rate is normal, it's natural, every broker is going to make a spread from you, but you need to work with brokers that are not going to use it as a stop sweeping tool, a stop hunting tool, in a manner that excessively increases the variability of that spread rate against you. This is Tips on Trading and Stephen's Story.